Hello, friends. Welcome to today's market update. And the main story since early Asia was again Chinese yuan, and it continues to drop, and it went past 6.60 for the first time since mid-December, and it's not surprising because it's the ideal, is the natural reaction to Trump's trade war antics. So PBOC and China would like to see yuan steadily lose altitude, so that it helps, it helps absorb any shocks from you know, Trump's Trump's trade war tactics. But it's not a good news for economies like India, because yuan being a regional anchor, when it slides, it drags Indian rupee along with itself, and no wonder it hit Indian rupee fell to a record low of 69.09 per dollar today. I'm not saying that it's just the yuan that's behind rupee slide, because rupee has been losing ground right from January, and there are a number of reasons. Like some people say policy paralysis, then high inflation, current account deficit, rising oil price is one of the main reason. Uh, and of course, the Fed rate hike and the resulting widening of the yield differential in the USD positive manner. So all those factors were already present. What yuan simply did was it accentuated or bolstered the bearish pressure around the Indian rupee. Other regional currencies also dropped, and when you have a currency as strong as yuan, when I say strong, I mean backed by such a huge current account surplus, it tends to drag other currencies lower with it, and not just Asian currencies, but the effect goes across the globe. The first victim usually is the Australian dollar, followed by New Zealand dollar, and as you can see on any web, any forex portal would would show you that dollar is on the rise, and it's solidly bid against most currencies. And the other factor that I would like to point out here is gold. The yellow metal, as it is popularly known, it is not really a metal. It's a precious. It's a hard currency with a limited supply, and it cannot be printed out of thin air like most paper currencies. And so you have a hard currency with limited supply falling against US dollar. So if a hard currency like gold is on the decline, uh, what chance would other paper currencies like euro, pound, or yen would have against uh, the greenback? And so it's no wonder that greenback is on the rise, is on a tear. And one thing that I would like to point out here is dollar yen has moved above. Let me just check. Dollar yen is trading at 110.45, so it's well above the 200-day moving average. If you have a look at the yield differential, that is the spread between the 10-year treasury yield and the 10-year uh, Japanese government bond yield, then this move about 200 DMA looks like a bull trap, because the yield spread is creating a head and shoulders pattern. If you followed my write-ups on FX Street, you already know this. So this looks like a bull trap, but I would still be still looking for a further rally towards 111, for because yuan is falling, USD is on a tear, because gold is just losing altitude despite all the risk aversion and trade fears. And also the technical setup looks bullish for now. This week, the bears have persistently failed to push USD JPY below the confluence of ascending trend line drawn from March 26, and the 50-day moving average, which is also biased bullish. And further, the money flow index, Chaikin money flow index, has turned positive. So I think the pair could go as high as 110.70, which is a falling trend line, drawn from 111.40. And if the trend line is crossed in a convincing manner, obviously we are going as high as 111.40 again. So there is merit in being bullish on dollar yen right now. And as far as oil thing is concerned, oil has U.S. oil prices went past. Let me check, 73, I suppose. Yep, U.S. oil prices are about 73, trading at 73.44, which is the highest. Went past 74. The intraday high is 74.03. So it's the highest level since November 2014, and it is just it's just on a tear. And I believe this is bad news for OPEC, because the faster it, it rises, or the higher the oil price, the higher would be the inflation across the advanced world, and then the central banks would be pressed to hike rates at a faster pace. We already have Federal Reserve. It signaled faster pace of tightening earlier this month. Although they kept neutral rate unchanged, which indirectly means that policy tightening will end sooner than expected, and that is somewhat of a good news. But if oil continues to rise, then inflation could rise even at a faster pace, and then maybe Fed would be forced to raise the neutral rate, and then that would be a big bad news. On similar lines, other central banks, European Central Bank and BOE, might have to tighten their screws. More importantly, central banks in oil-consuming nations like China and India would have to tighten the screws in response to oil-led spike in inflation, and that would end up hurting demand. So it's bad for OPEC. Rising oil prices is bad for OPEC, and it's bad for economies like India. Again, no wonder their currency just hit record low. So, technically speaking, oil is looking overbought right now, and I would refrain from being a buyer at this level. I would like to see a good healthy pullback. The RSI is inching closer to overbought levels, so it makes sense being on the sidelines here. And so that's the story for today. These are the important points in my opinion, and I'll catch you up tomorrow. Thank you.